美联储最新的3月利率决议宣布，将联邦基金利率目标区间维持在0至0.25%的超低区间，符合市场预期。此外，美联储上调了美国经济的预期，预计2021年美国 GDP 将增长6.5%，高于去年12月的预测。美联储主席鲍威尔表示，在美国国会和美联储前所未有的支持之下，美国经济大幅改善。不过，他警告称，美国经济复苏仍远未完成。此外，美联储在3月19日宣布 ，SLR 于本月底到期后不再延续，令市场哗然。10年期美债收益率再度飙升至1.7%上方。2021年以来，美债收益率持续走高，引发投资者对流动性以及通胀的担忧，进而导致全球市场出现大幅调整。与此同时，日前，美国国会通过规模高达1.9万亿美元的新一轮经济救助法案，市场通胀预期持续升温。那么，美国通胀前景究竟如何？美联储货币政策何时会发生变化？投资者又该如何应对多变的市场？全球财经连线就以上问题独家专访了穆迪分析首席经济学家 Mark Zandi。财经热点深度解读，这里是全球财经连线。大家好，今天我们邀请到的嘉宾是穆迪分析首席经济学家 Mark Zandi， 就美联储货币政策、美国经济复苏前景、美债收益率上行等市场关注的问题进行深度解读。Hello Mark, great to have you here today.
It's good to be with you. Thanks for having me.
Thank you. The Federal Reserve kept rates unchanged and maintained the current pace of asset purchases. But recent economic data showed that the U.S. economy is getting better. Why did the Fed keep rate unchanged?
Well, the Fed's made it very clear that they're not going to raise interest rates, short-term interest rates, until the U.S. economy is at full employment, so everyone's back to work. So that would be something closer to a 4% unemployment rate, and the current unemployment rate is well over 6%, so we've got a ways to go there. And moreover, the Fed has told us they won't raise rates until inflation is consistently above their 2% target, and also we've got a long way there as well. So I don't think the Fed will be raising short-term interest rates anytime soon.
Do you think the current Fed policy is still correct?
I do. I think the U.S. economy is still struggling. High unemployment, underemployment, inflation still below target, the 2% target. And the pandemic is still on. We're making a lot of progress. People are getting vaccinated. I think we'll be on the other side of the pandemic later this year. But until then, I think we need to be on high alert. So the Fed needs to keep its foot flat on the accelerator, make sure that the economy continues to improve.
The Fed indicated that there are no interest rate hikes likely through 2023. In your opinion, when should the Fed begin to raise interest rates? Why?
Well, I think if everything sticks to script, if we get to the other side of the pandemic later this summer and the economy continues to improve because of all the fiscal support and all of the pent-up demand and cash that households have to spend and the growth continues on, I think by early 2023, 2 years from now, I think the Fed will be in a position to start raising short-term interest rates. So I think we've got another couple of years of short-term rates close to the zero lower bound.
Well, 2023 to be too late for them to adjust the interest rates.
It's possible. I mean, if the economy is really strong, boom-like, and inflation picks up to a much more significant degree, it's a lot stronger than anticipated, then they'll be under pressure to raise short-term interest rates sooner than what I expect. So I wouldn't rule that out. That's a real possibility. But I think at this point, given all that we know and given all the uncertainties, the most likely scenario is that it'll be a couple of years before the Fed starts raising short-term rates.
Stocks respond positively to the Fed meeting results, with the Dow Jones Industrial Average up more than 200 points, while longer duration government bond yields stayed positive. But in a recent interview, you said that the economic recovery will unleash strong inflationary pressures and send a warning to the Wall Street. What's your predictions for the current stock markets?
Yeah, I think investors, stock investors, bond investors are only now catching up to the reality of what will be a very strong economy and higher inflation. So I think they're starting to discount that, and that's one reason why bond yields have risen, long-term interest rates have risen, so bond prices have fallen. And of course, stock prices, they've been going up and down and all around, but they basically gone sideways since the beginning of the year. And I think that's because investors are coming to grips with the reality that, yeah, the economy is going to be strong, and that's good for stocks, but that also means higher inflation and higher interest rates, which are a headwind. So the net of all that is basically a flat equity market, stock market.
Are we waiting for a correction?
I think that's a high possibility, a strong possibility, yes. I mean, I think valuations are very high. The market is stretched. I don't think it's a bubble. I don't think we've gotten to a place where people are buying stocks and simply because they're going to sell them quickly, try to make a profit. That's the kind of speculation that was prevalent back, say, in the Y2K bubble, 20 years ago. So I don't think that's what we're seeing, but valuations are very, very high, even given the low interest rates. And as interest rates rise, I think that will put pressure on stocks, and the correction is a distinct possibility sometime, certainly in the near future.
Globally, major central banks have offered easy monetary policy to support the economics in 2020. Now, the expectations for inflation is moving higher. Do you think inflation could be a big problem in 2021?
I think we'll see a spurt in inflation. Global supply chains have been disrupted because of the pandemic, and as demand picks up, as the U.S. economy kicks into a higher gear, we may see shortages for different types of supplies. Everything from lumber and copper to oil and agricultural products. So we could see spikes in prices, but I think those are going to be temporary. And that we'll get to the other side of that. Inflation will still be below or close to the Federal Reserve's 2% target. So yeah, in the very near term, say over the next 3-6 months, as the U.S. economy really ramps up, we could see some high rates of inflation, but I would think they would be temporary, not persistent enough.
What kind of risks will inflation cause?
Well, I mean, if inflation is undesirably high, then of course, that cuts into people's purchasing power and real incomes and ultimately weighs on the economy. High rates of inflation make it more difficult for businesses to invest. The cost of investing is higher. And of course, higher inflation means higher interest rates, and that'll be hard on anyone who's been borrowing and will now have to pay more for their debt. So, there's lots of different ways high rates of inflation, if they get too high, can become a problem. But let me say this, I mean, we've been, the entire global economy has been struggling with low inflation, disinflation, deflation in many parts of the world. That's been our problem for the last 20, 25 years, not undesirably high inflation. So I think, at this point, it would be more desirable to get inflation back up, even if it was a little bit higher than anyone desired for a while, just to break free from the low inflation, deflation, disinflationary environment we've been stuck in for many, many years.
Mm-hmm. I also want you to talk something about the U.S. bond market. Why the bond market is so hot? Is it because of the inflation?
Yeah, it's really the strong growth, the prospects for the Fed to keep short-term interest rates low for a long time. That's causing investors to mark up their expectations for inflation and real growth. And those are the two key drivers of overall interest rates. So, if you think the economy is going to be really, really strong, unemployment is going to be declining, inflation is going to be picking up, as a bond investor, you're going to demand a higher interest rate for all of that. And I think that's what we're seeing. And that'll continue. I don't see any reason, given the strength of the prospects for a very strong economy dead ahead and for inflation to pick up, that means interest rates should continue to move higher.
Biden has already signed $1.9 trillion stimulus package. As the U.S. economy is recovering and the rollout of COVID-19 vaccines is quicker than before, do you think it's essential to release a new stimulus package at this moment?
I do. As I said earlier, the U.S. economy still is struggling with the pandemic. Unemployment, underemployment are still very high. Inflation is still low, below the Fed's target. So yeah, I think it makes a lot of sense for the administration to continue to provide a lot of fiscal support to the economy. In the $1.9 trillion package, if you do the arithmetic, that gets the U.S. economy back to full employment a couple of years from now. And I think that's desirable. Now, if the Biden administration wants to do another fiscal package, and we're already talking about that, then I do think that package will need to be paid for. That means, it has to be deficit neutral. It can't add to the nation's deficits and debt, because at that point, then we'll probably overdo it, and inflation might get undesirably high. We might overheat. Certainly don't want to see that. So I think the next fiscal package, if it includes things like infrastructure spending and more spending on social programs, needs to be paid for with higher tax rates on big corporations and high income, high net worth households.
We all know $1.9 trillion stimulus package will increase the U.S. government debt burden.
But why do you think we need this package?
Well, the U.S. unemployment rate is 6.2%. That doesn't include several million people who are not looking for work, who are unemployed but not looking for work. They've stepped out, maybe parents taking care of their children because schools have been closed, or taking care of sick family members that have gotten sick with COVID. And if you consider those folks, then the underemployment rate is close to 8%. In a well-functioning economy, the unemployment rate should be 4%. So that's a lot of underemployed people. Many of them have permanently lost their jobs. It's going to be hard to get them back to work. And with that, I think it makes a lot of sense for deficit finance fiscal support, temporary deficit finance fiscal support, to get the economy back to full employment, get everyone back working as fast as possible.
Do you think it will be a big problem in the long term?
Yes, in the long run, the U.S. is going to have to address its fiscal situation. Once the economy is back to full employment, once the economy is off and running and inflation interest rates have normalized, I do think that it will be critical for U.S. policymakers to address our long-term fiscal situation. And that means both restraint on government spending growth, but also higher taxes. It's going to take a combination of those two things to rein in our long-term fiscal problems. But let's not put the cart before the horse, as they say. Let's get back to full employment first, and then once we're there, we can address our fiscal problems.
The Fed upgraded expectations for GDP growth and inflation, and cut estimates for the unemployment rate. What's your outlook for the U.S. economy in 2021?
Yeah, my view is very similar to the Fed's. I think the Fed's forecast for GDP growth, I think it was 6.5% fourth quarter of 2020 to fourth quarter of 2021. That sounds just about right to me. I think that's the kind of growth rates we should expect. The Fed's also expecting unemployment to fall. I mentioned we're over 6%, and they expect it to fall to 4.5% by the end of 2021. That's also a very reasonable forecast given all that we know and the strength of the economy that we're likely to get here in the next few months.
Finally, do you have some suggestions for the investors?
Well, I think for investors, it's as they say, the easy money has been made. The markets have rallied very strongly since a year ago when they bottomed out, particularly stock markets. And I think going forward, it's just going to be more difficult. Interest rates are going to be on the rise, and when interest rates are on the rise, that puts downward pressure on all asset values. And so I think for investors, it's going to be more difficult to make a high return. And they're just going to have to be more careful, cautious, and do their homework.
Thank you for your time today.
Thank you so much.
Thank
Take
you.
care
Bye.
now. Bye-bye.
Bye.